everybody, welcome to another episode of Ask My Fund Manager. Today we have Mr. Chintan Haria with us, who is Chief Investment Strategist at ICC Mutual Fund. Mr. Haria has worked with ICC Mutual Fund for last 18 years and he is one of the most respected voices in the world of mutual funds. Today we will discuss with him about the relation between A's and investments. So welcome sir, welcome to the show.
Thank you as well.
Pleasure having you always. I still remember vividly when you came to our event last year.
Yes.
And you were the last in the row, but you kept everybody spellbound all because of your oratory skills. Sorry, you were first in the. You kept everybody spellbound by your oratory skills. So, sir, today the topic that we want to discuss is the relation of investment with A's. So, my first question is: at what age should one start investing?
So I think one should start investing as early as possible, and I'd say that you investing for yourself is fine, but we should start investing for our kids.
Yes.
And our nephews, nieces, everyone. So in birthdays, we typically have this habit of giving some gift, right? पहले covers देते थे, अभी सिर्फ दे दो. It's as simple as that. It's not that difficult and very easy now with the digital age, and of course your team makes it very easy as well.
Thank you.
So whenever there is a birthday in any family of a kid or a child, even if it's a newborn child, etc., just start a folio, start the SIP, and by the time the child grows, the child would have also learned. So the earlier you can start, the better. And of course, the more SIP in terms of the amount. So it has to be quantity-wise also meaningful, and of course, as early as possible.
I like the point that you made about it's being digital and it's being convenient. I'll share my own experience with the same. When I started my practically the first job in 2008, so I had this kira कि I should have SIP in place before my first salary. And I still remember I used to fill forms and I used to go to CAM's office. I used to deposit forms over there. I had to take checks, etc. And now everything can be done at a click of a.
Absolutely.
So my next question would be कि if I look at A's, so are there any buckets which should be there for investment in the sense that at this age you should do this kind of investment, for this age you should do this kind of investment?
So there was for long there was a saying, right? Whatever is your age, you minus your 100 minus your age should be your equity allocation. And I think now age is not the barrier or age is not the factor at all. It's all about asset allocation. And thanks to advisors and guides like you, I think most investors are now not worried that what age they are because the asset allocation is taking care of their requirements. Yes, but if you start a little late and you are very close to your retirement, then you need to be a little bit more cautious as to how and where you invest. But otherwise, age is not the deciding factor, it is the asset allocation. So I think one thing which all of us should focus on is the asset allocation. And luckily for us now, you mentioned about 2008, around the time that the India's first asset allocation fund was launched by us in 2006-07, and I think today it's a household name. So we firmly believe that core portfolio should be the multi-asset fund, the balance advantage fund, will do the job of asset allocation for you. Then you really don't need to worry about your age. Suppose you are towards your retirement and you need your cash flow needs. From a taxation angle also your cash flow needs become very, very, let's say, tax efficient if you do it from a multi-asset fund or a balance advantage fund kind of a fund because they are equity assets. So you can actually manage a lot of stuff with just your asset allocation schemes in place. Of course, if you are younger, you have a longer runway, then you can take it a bit more aggressive in terms of the allocation. But I would say very clearly, don't focus on your age too much, focus on your asset allocation. Forget the A of age, focus on A of asset allocation.
So for the benefit of our audience, can you just take us through the term asset allocation, what it means, how it is implemented at portfolio level, at mutual fund level?
Yeah, absolutely. So if you look at a very common example, and I think most of us love cricket, right? Or even if we say Bollywood. So you need all kinds of elements to make a Bollywood movie successful. At the same time, you need probably a good batsman, bowler, keeper, captain, all-rounder to make a cricket team successful across various types of pitches, across various types of opponents. Similarly, across various types of market cycles, right? Sometimes markets are what they are in the last 3-4 years doing exceedingly well. Then we saw COVID, the markets fall. Then there's some unknown event. To plan for that, you need to have an asset allocation in place. And what is asset allocation in simple terms? Having different kinds of products in your overall portfolio which give you access to not just equity but debt, gold, REITs, InvITs, now silver ETFs are also available. So within the financial investments alone, you get a good diversification, and within equities again there is mid cap, large cap, small cap, thematics, there is active, passive. So you build a portfolio which has the best of everything, because there are certain, for example, if you want to play momentum, and momentum is part of some portfolio which is in the index fund, you can participate in that as well. So you have a core portfolio of balance advantage fund, multi-asset fund, and you build your asset allocation around it. What asset allocation is supposed to do is essentially help you tide through the market cycles of ups and downs without you having to keep changing the portfolio. Because when you change the portfolio, there is obviously a taxation element, there is a risk of you entry and exit at the wrong time, and obviously you really don't want to focus on your portfolio all the time. I mean, you will do a good job for them, but let them also have it peaceful, let you also have it peaceful, and it works well. And we all know India is for the next 10 years, 15 years going to grow. We are a very young country. So in simple words, asset allocation is having a little bit of all asset classes in the right proportion, right time, and of course you will build on it with the right sectors, etc. So it's not like asset allocation means you don't do anything. You have to still every 6 months or 1 year look at your portfolio, change your portfolio depending on market directions and news. And today markets are changing so fast. So we have US elections, we have a possible Fed rate cut coming in the next week or so. So we have to be mindful, and it's a very fast market to keep changing. But the core is asset allocation, where you have different elements in different proportions across all asset classes in which financial assets are available.
So I'm so glad that you answered my next question also partially in your answer. You should have asset allocation at mutual fund level because that makes it more tax efficient. But I'll still ask the question. So, when it comes to asset allocation, there can be two approaches. One is at portfolio level, ki I buy equity fund separately, debt fund separately, I buy REITs, etc. separately. The other can be at mutual fund level, ki I buy a multi-asset fund. But I hope you will appreciate ki everything can't be in multi-asset. As you said, there has to be a core of multi-asset. So if you could just take us through how I should build my portfolio using mutual funds at portfolio level and then at mutual fund level.
Yeah, so if you look at one, mutual funds today provide all the potential financial investments that you need. Yes, for those who are slightly more aggressive, the PMS or the AIFs are also available, which provide differentiated investment opportunities also, which probably can go down the market cap curve also and give you a little bit more aggression and a little bit more return should your risk appetite provide. And if you look at the mutual funds in terms of the structure and the creation, clearly, mutual funds today can be a core to create a full portfolio. And what should be the percentages, right? So let's look at it. About 40 to 50% should be a core. I mean, typically, if you look at most of the great Indian victories, there's been one person who's stood like a wall on the other side, and there's one person who is the aggressor, right? So you need a balancing, steady hand on the other side to hold the portfolio strong. And that balancing, steady hand to hold the portfolio across market cycles is balance advantage fund and multi-asset fund. I can add equity and debt fund also. So anything which is hybrid, right? Anything which is hybrid, and more so something which can change its equity allocation and provide you different asset classes within the same fold. So clearly, multi-asset balance advantage fund coming forth can be 40 to 50% of your portfolio. Once you have this 40 to 50% of your portfolio as a steady, strong hand, and empirically also I've seen that when markets are rallying as much as they are, people tend to move towards the most aggressive investments. When markets are probably in the depths of the doom, so to say, something like March 2020, people want to move away from equities completely. This 50% will keep you in balance. In fact, in 2020, when everything seemed doomed, this would probably tilt towards equity. And when 2024, right now, and everything seems so great, because valuations are not the cheapest, they will modulate your portfolio and they will be at the lower end of equity levels. So your equity levels will come down in this particular bucket, depending on which product you choose. Plus, you get probably gold exposure, silver exposure, even debt exposure, REITs and WITs across this basket, which also gives you some amount of stability. So that's 40 to 50%, wherein you get the balance advantage fund, multi-asset fund, equity and debt fund, uh, maybe even a blue chip fund, because large caps also are supposed to be a little steady. Then the other 50%. Now, in the other 50%, of course, once you made a strong foundation, you have the scope to expand your horizon to everything that India has to offer. We are in a country which is blessed, where because of the 140 crore Indians plus the resources, we have our own energy, own food, own manufacturing. Lots of stuff is happening and lots of things are changing. So, just by being 4%, I think, of the world GDP, we are already the second largest in steel, second largest in cement, and this I had, I think, mentioned even when we spoke in your event. But second largest in steel, second largest in cement, third largest in cars, the largest or second largest in air travel, largest smartphone user, largest 5G user, largest 5G user plus largest data user, and there are many other. Of course, the most populated country, the youngest one of the youngest country, fastest growing country. But even with that, right, the good news is that in India, because government may not want corporates to profit here, but governments want corporates to make profits, reinvest those profits, and grow. We are seeing a steady growth in corporate earnings reflected in market capitalization. So the question which comes generally is, right, um, are we at the peak? Benchmark indices, are they at their peak? So I say I started my career in October 2005. That was a peak, but that was 1/10 of where we are today. And let's remember, from October 2020, 2005, our economy in October 2005 was only 25 lakh crore. When I say economy, means GDP, the sum total of economic activity that India had at that point of time, October 2005. It's not very far, just about 19 years back, was about 25 lakh crores. That 25 lakh crores today, we are touching 320 lakh crore. So the economic size has increased, and because the economic size has increased, the corporate revenue, corporate profitability has increased. This is a refresher for those who would have heard me last time, and that is basically reflecting in the values of the companies and across sectors, right? So we have the largest technology outsourcing, we all know, and now if you read Economic Times today in the morning, global capability centers, which is essentially the in-house capability centers of foreign banks and foreign companies, where they basically do their back-end work in India. That's already $64 billion of revenue in 2024 and targeted to be $100 billion in the next 3 to 4 years. That's almost mirroring the tech or the technology outsourcing industry, and that's huge, and it gives employment for India. So pharmaceuticals, of course, we know that India is a large the largest outsourcer of pharmaceuticals or medicines, and in terms of export, I should say. And with the US Biosecure Act, which got passed, I think 3 or 4 days back, even the back end, which is the contract manufacturing, the APIs, etc., Indian companies should benefit. So there's a lot of effort and there's a lot of opportunities, and hence, if you see in the markets, we have pharma, technology, infrastructure, all booming for different reasons. Government focus on infrastructure means we are spending 12 lakh crores on infrastructure. This number just about 6 years back was less than 3.5 lakh crore. So the change which is happening in India is rapid, and we are seeing that basically reflecting. So the balance 50% should be, and definitely should be, in industry sectors themes which are participating in the India growth story. So your typical flexi cap funds, your large and mid cap funds category, your PMSs, your even your ETFs and index funds, whatever combination you think is right, the investors should follow. And here, of course, my thought process and your thought process can be different, but the objective is that once you set this 50% as par, the other 50% can be anything as per your liking and my liking. Because I can at different points of time have different risk appetite, and it's more so about the investors. So some investors may actually have a very high risk taking ability, and you can create the portfolio for them like that for the balance 50%. And some investors may have not such a risk taking ability. And also depending on the investors in terms of what age they are, what are the requirements, then you can think of having the SWPs and the cash flows, etc. So through mutual funds, you can actually create a full-fledged wealth creation plan as well as a family support for contingencies as well. And I think this asset allocation plays a very important role in that.
Great. So two points that I loved. One is that you reminded us of Sehwag and Dravid. You know,
Yes.
one conservative on one side and one aggressive on the other side, which is one of the best memories of
Yes.
all of
At
us
least,
who.
at least people are fast.
Second, that every peak is a reminder that this is going to be the older peak and lesser peak than the next one. And so glad you cited so many good numbers about India. I think iPhone is another good story where we recently have 1.5 lakh direct employment and 4.5 lakh indirect employment. And now we are manufacturing 15% of their global production, and now it's going to be 25%. And now they are also targeting component manufacturers to have more value added services
Yes.
in the India.
It's also happening in autos and auto ancillary. Like I said, India is already the third largest auto. So China sells 2.5 crore cars. We sell only 40 lakh cars a year. Similar population, but we are one-fifth their size, of course, in terms of GDP. And the back-end auto components also, if you look at it, India has always had strong auto component capabilities because engineering and
Yes.
India, we are very strong at engineering skills. And so the back end, India has very strong companies already listed in auto ancillaries also. And a lot of the European auto ancillaries was in Europe, which is becoming unsustainable because of costs being high over there. And European car manufacturing companies are looking at actually moving towards India for setting up base to export and also the back end in terms of auto ancillary. So that's also a very big scope for India. Today, in fact, you mentioned about electronics. I think yesterday in one of the speeches the Prime Minister mentioned India has $500 billion potential for electronics because obviously we all are consuming more of phones, more of televisions. Earlier in a family there used to be one landline phone and one I think a cathode with CRT TV, right? And today I think every room has a TV and everyone has one phone or maybe even two phones, and that applies to cars as well. Cars used to be a luxury. One person used to have a car. Now it's not just a luxury. Two people working and maybe one car for the house. So that's also common. Even air conditioning for that matter, right? India has, I think, an air conditioning penetration which is extremely low, about 7 to 8 out of 1,000 versus let's say 50 to 60 in China and almost 100% in US. So air conditioning penetration with the heat and the heat wave that India is seeing, extreme weather, that is also going to increase meaningfully. So I think the scope is unlimited, but what we should not forget while everything looks good is that markets have their cycles. And so I go back to the fact that asset allocation will ensure we don't have to worry about the cycles. At the same time, we participate in India's growth story because we are today $4 trillion roughly or 320 lakh crore of expected GDP in the next few months. And that's likely to go to 6 trillion, 7 trillion, 8 trillion, even 10 trillion in the next maybe 5, 10 years. And we are the fastest, largest growing economy with a population with a median age of 27. So the building blocks are in place. We have wealth, which is immense. We can see that, right? 23,500 crore SIP in August. This just about 5 years, 6 years back, this number of SIP was less than about 8,000 or 7,000 crores. So I'm not talking 20 years back. The rate of growth of SIPs is also showing Indians are saving, Indians are ready to invest. An SIP book of 23,500 crores is reflection of that. Mutual funds today own almost 10% of India's equity, 9.2% to be precise, I think, as per the June data, and this number was less than 1% 10 years back. So today mutual funds are becoming a potent force, and hence, like you mentioned, you can create an entire portfolio out of mutual funds, and if it is 9.2% today, FIs are 17.5. So as they say, David versus Goliath. Foreigners used to have 22% of Indian mutual funds were less than one. Today we've already reached 9.5 and 9.2, and foreigners are down to 18. And we are growing while they are selling. So there will be a time where India will become basically self-sufficient in capital required for the market. It's already happening, and we are very glad that it's happening in a manner. Only thing which we need to be cautious again, and I'll repeat, never lose sight of valuations. That's more applicable to you. I would probably guide my attention to you that don't lose focus on valuations while you create the portfolio and ensure that there's nothing which is so expensive that it does not justify being in a portfolio of a client, because there are pockets of expensive areas in the market where we need to be cautious, and there can be a time correction or a mild correction or a fall, we do not know. But let's remember, when something is very expensive, it can fall a lot more. When something is not so expensive, the chances of you losing big in that is not very high.
Great point. So, Chintan, one anecdote that we have been seeing of late is that from the days of being a traditional retirement kind of corpus through mutual funds, etc., a lot of youngsters are using mutual funds for their immediate needs also. So, like, I need to go for higher education, I need to get married,
Yes.
and the immediate temptation is कि I should have small cap and mid cap in the portfolio even for 2 years. Now, why I'm asking this question, because you made a very pertinent point about valuations.
Yes.
And certainly, valuations are also indirectly a function of my investment horizon.
Of course.
So, what are your views about the same?
So clearly, asset allocation will play a very important role in that. Small and mid caps in India are the building blocks for all the large caps. So, as it said, yesterday's small caps are today's large cap, and that's how it functions, right? Many of the companies which are large caps today were small and mid caps maybe 15, 20 years back because they grew their business. So, that's the space from which you will have multi baggers and winners. And at the same time, because that space has smaller floats, smaller market caps, if a lot of money does flow into that space in a short span of time, like we've seen in the last 4 years, the rally in the small and mid caps is meaningfully larger. So they have faster growths, and then when the turn happens in the market cyclically, they also tend to have more drawdowns or losses or fall in prices, as in simple terms people will understand. So today, if you look at it clearly, there is a case for moderating exposure to small and mid caps if you have it high. While there is no common number that I can put it, but ideally not more than 20% in small and mid cap. If you want to balance your portfolio, if your risk taking ability is high and you have a longer time horizon, then you can possibly continue to have more, or just have a look at what has been your past experience. So, if in March 2020 or 2021 you are at a lower small cap mid cap exposure, then today having a larger small and mid cap exposure may not logically make sense because all of them are more expensive. It Your circumstances may have changed, so maybe you have more risk appetite and you are larger, but generally try to moderate the exposure if it has gone too much high. And I would say that 20% is a good number to go by from a risk reward perspective, up to 20%. Because if many of the people have reached 40, 50, because new money has gone in small and mid cap, old small and mid cap has grown, SIPs in small and mid cap high. So if you reach 40, 50, try to moderate. It's not like you basically get out of it, but try to moderate yourself, try to take some money off the table, because I think we made really good money in the markets in the last 4 years, 5 years in that space. And purely from a market capitalization perspective, of the 474 lakh crores that 470 lakh crores that India has in terms of market cap, 40% is mid and small cap, which is the highest ever. About 20% or 18.5, 19% is mid cap, and about 20, 21% is small cap. So this is itself very high. Normally, under normal circumstances, mid plus small is 25% and large cap is 70%. That's normal. Today, large caps, because they have underperformed mid and small cap in the last 4 years, mid and small cap has gone to 40. So clearly, there is some amount of euphoria, little over ownership, and valuations. Of course, if I look at the headline numbers and index levels, sometimes I mean it's more than 30p, which typically is normally a sign where you need to be a bit cautious. So I wouldn't say that they will not grow. I would just say that your expectation of growth. People are investing today thinking, okay, 30% last year, 30% last year, 30% last year, last year. In fact, small cap index went up 60%, mid cap index went up 50%, and Nifty went up, I mean, the large cap index went up 26, 27%, if I'm not mistaken. People are extrapolating that, and I think it's drawing a lot of people. I think moderate your return expectation, think of portfolio approach always, and you may be lucky that next 6 months go like the previous 6 months, but let's remember it's essentially the earnings which are reflected in market cap valuation creation. Temporarily, more liquidity coming in can take the stocks higher, but you need earnings growth to support long-term sustainable valuation value creation, which does not happen overnight. So, return expectations should be moderated across market because last 4 years have been so fantastic. At the same time, have a 10-year view. You mentioned about people wanting to invest today for their higher education 3, 4 years down the line on average, etc. Of course, goals which are more than 5, 7, 8 years are fine, but if you have a goal which is in the near next 2 years, 3 years down, and you are investing today that okay, I'll meet that goal, you can be in for a surprise negative view also. So, if you need money in the next 2 years, I would strongly recommend rethink whether you want to be in equities with that money, because equities does not tell us before they have the fall, and I do not know whether there will be a fall or not. But if you need to marry in 2 years' time and you need that money, you cannot be caught in a space where you are losing that money and you have to marry at that time or you're going abroad at that time. So anything which is more than 5 years, it's fine. But if it is less than 5 years or 3 years, be very cautious of being invested in pure equity. If you're in hybrids like, let's say, a balance advantage fund category, I'd say you're still okay, you're moderated. But pure equity, be very cautious if you need the money in 2 years' time, whatever amount of money you need in 2 years' time.
Great. So your buffet should not become smaller because you invested in wrong categories.
Yes, exactly.
Thank you, Chintanji. Thanks a lot.
Thank you.
Thanks for all the knowledge and all the insightful.
Thank you so much. Thank you as always.
Yeah, thank you.